and we're just going to go live. Someone has sent in a question and they have said, you often talk about Charlie Munger's rationality. Do I talk about anything else? I mean, it's pretty much what our brand's based on. Anyway, you often talk about Charlie Munger's rationality. What would Munger look for if he were to invest in startups? I'm not going to talk just around what he would look for in startups. I'm going to talk about what he would look for when investing in general. Publicly listed companies, it'll apply to startups too, but where it doesn't, I will actually state that it doesn't. If I were to go in detail, we could be here for a while, but really the whole thing around Munger is around keeping it simple. And so I've cut it down to really 4 main things. There are other things he mentions too. Let's get into it. These 4 things are, number 1, be capable of understanding the company. Stay within your circle of competence. And I mean, Munger has this pretty well-known quote. I mean, he has a lot of quotes, but he says, knowing what you don't know is more useful than being brilliant. Acknowledging what you don't know is the dawning of wisdom. So essentially what he's saying is, identify your circle of competence and use your knowledge when possible to stay away from things that you do not understand. Yeah, I mean, avoiding stupidity is easier than seeking brilliance. So this principle really relates to another one of Munger's sayings where he says, people are trying to be smart. All I'm trying to do is not be idiotic, but it's harder than most people think. And another quote, which is, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So how do you stay in your circle of competence? Well, one would think, if we were to think from first principles, you'd have to develop this circle of competence from somewhere. How? Well, pretty basic. Read more to learn more about a particular company, industry, or market. No secret that Munger and Buffett read 500 pages a day, and the importance of just sitting and thinking to complement the reading, because you're consuming all this information for hours and hours, but then where is it, what are you doing with it? So you're storing it, but then you need to process it. So after the reading, these guys are actually known for either sitting and thinking alone for hours, or going for very long walks as well. And I've mentioned this before. Cal Newport talks about this in Deep Work, this sort of meditative or stoic practice where you just go on a long walk, and if you're tackling a tough problem, whether you're an investor, computer scientist, whatever it may be in life, whether you're a startup founder, if you're tackling something during the day, you'll actually often get the solution as you're on your walk, obviously without technology, just you and your thoughts. And people cannot just sit still, and they have zero attention span in a modern day. I mean, Munger was clearly implementing Cal Newport's Deep Work long before Cal was even born. And there's a great saying that along the lines of, most of man's problem comes from his inability to sit in a room alone. So number 2, what Munger would look for is, it must be a business with a moat, an intrinsic and durable competitive advantage. Because once you've done your in-depth diligence and committed, you know that even a few years of bad performance won't lead to a loss of sleep. Peter Thiel talks thoroughly about this and how he looks for startups with a monopolistic-like characteristic. I wonder how technological substitution, as with horse carriages going to cars, compares to possible brand or taste substitutions like Coke, in terms of how easily either can get through moats. And what I mean by that is, would a product like Coke, which cannot really be suppressed through tech, have a stronger long-term moats? Even Coke Zero couldn't beat Coke as a product. And you look at Blockbuster, they had a video moat, but Netflix came flying over with technological innovation and took over. So it's tougher to predict moats in tech companies and startups. For instance, are you saying that you could have looked at Google 14 years ago when their monopoly characteristics were obvious and predicted their earnings in 2021? I mean, I doubt it. Come on, guys. But in tech, moats, I mean, the only way I kind of see it, there are a few ways. One is probably if it's a B2B SaaS with a mission critical solution and high switching costs, A few other things have to go right as well. It could probably have a moat. But if we were to just look at companies in general, not tech or startups alone, if we're talking about brand moats, we're talking about Coca-Cola, we're talking about Disney, we're talking about Starbucks. A parent wants to just put on a video for their kid. Where's the first place they even go to? It's just, instantly they just think of a Disney movie. So similar with Coke, when you want a soft drink, brand moat is very important, as with Starbucks. You also have cost moat, so we're talking about, cost advantage. And what springs to mind here is Geico, which obviously made Warren Buffett's favorite stock. And the ultimate key to Geico's success is its rock bottom operating costs. So they have a cost advantage, which virtually no competitor can match. And that leads to a moat. The third thing Munger would look for is the company should have trustworthy management. And of course, this applies to startups and just any and every company, even if it's publicly listed. Integrity and talent goes a long way. The company should be able to withstand human error, because eventually someone's going to come along and screw this company up. You want a company that can handle that and get back on its feet within a few years. Examples that spring to mind instantly: Peter Kaufman, what a human being. Ethics and integrity and talent instantly springs to mind. Number 4, and the final, it must be a business you can buy for a price that makes sense, and you buy at a sensible price with a margin of safety to mitigate any potential risks. Munger in the Berkshire annual meeting in 2003 said, "In engineering, people have a big margin of safety, but in the financial world, people don't give a damn about safety. They let it balloon and balloon and balloon." So look, this margin of safety concept is about making it likely that you have the odds significant in your favor by trying to find a substantial cushion in terms of the odds. Munger doesn't believe that this happens very often, particularly when it is in your circle of competence and the other investing filters are in place. Since finding a significantly mispriced bet doesn't happen often, when it does happen, Munger says you should bet big. Investing is where you find a few great companies and then sit on your ass. And also, if you are investing at the pre-seed stage, especially for startups, it doesn't apply in this case. If you're, for example, throwing just a $25,000 ticket at a pre-seed round as an angel, that doesn't count. There's no valuation methodologies to use. You're just betting on the team to figure it out. And this is where the power law comes in, and the dartboard analogy that Iman and I talk about, where as an angel investor or VC, you're throwing 100 darts at the dartboard, hoping one of them or two of them stick, the ones that become large companies or unicorns. But if you're looking at publicly listed companies, it's beyond the scope of this video. If I were to really summarize it in a couple of words, Munger has previously responded in the 2016 Daily Journal annual meeting, and he said, "Obviously, it's relevant what the return you get on your bonds is. That affects the value of other assets in the general climate, i.e. equities. Obviously, your opportunity costs should cover your own investment decision making. If you happen to have a rich uncle who will sell you his business for % of what it's worth, you don't want to think about some other investment. If the opportunity cost is so great, considering everything else, you should forget about it. And most people don't pay enough attention to opportunity cost. Bridge players know about opportunity cost. Poker players know about opportunity cost. But in an MBA faculty, members and other important people, they hardly know their arse from a plate of hot squash." And people continue to question him at this annual meeting around valuations, and he simply just ends with, "We don't use numeric formulas that way. We take into account a whole lot of factors. It's a multi-factor thing, and there are trade-offs between factors. It's just like a bridge hand. You have to think of a lot of different things at once. There's never going to be a formula that will make you rich just by going through some horrible process. If that were true, every mathematical nerd who gets A's in algebra would be rich. So you have to be comfortable thinking about a lot of things at once and correctly thinking about a lot of things at once. And we don't have a formula that will help you. And all that stuff is relevant. Opportunity cost, of course, is crucial. And of course, the risk-free rate is a factor, and among many other things, which I agree with. going back to the point we said earlier, circle of competence, reading, becoming a multidisciplinary thinker, as Munger and Kaufman talk about. These are all important things to have in your mental toolbox, you can say, to pull from when assessing companies in a multi-factor process. He is very similar to Terry Smith of Fundsmith, who says, buy good companies, don't overpay, do nothing. And Terry Smith, who's known as the English Warren Buffett, as Munger says, sit on your ass, you're paying less to brokers, you're listening to less nonsense, and if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum. So yeah, time is a good friend. I hope that helps. And this is not investment advice. Peace.